What's going on, everybody? Welcome to a Capital Hungry Market Update and Trade Ideas webinar. Currently 4:30 p.m. Eastern, roughly approaching the end of the North American trading session, Tuesday, February 7th. So it's not the Monday market update, but I had to delay it till today. Hopefully everybody can hear me loud and clear in the YouTube audience, and we will dive right into it. So, if you followed along the market update and trade ideas webinar that was given last week, you could see that we had central bank rate decisions and US economic data in terms of the labor market reporting in focus. We were seeing majority of major asset classes, whether you're looking at gold individually here, as it was retesting the 1960s very key liquidity zone seen before, or whether you are looking at the dollar retesting a very key weekly support level, or equities rejecting a previous key level, we were at very key price points of interest across the board. The catalyst, whether we make or break above these areas, was going to be dependent on the central bank rate decisions, with primary focus for gold, US dollar, and US equities being the Federal Reserve sentiment, and of course the US labor market data at the end of the week. So what we had take place in terms of the rate decisions was relatively neutral sentiment across the board. Priced in expected rate hikes, no new information being brought to the table, no real overall market impact either when you're looking at the overall decisions from Federal Reserve, ECB, and Bank of England. The main kicker that potentially is leading to some reversals of these trends that we've been seeing for the last couple of months since the end of 2022 was extremely optimistic labor market data. The extremely optimistic labor market data shows that the economy is still robust enough to handle more aggressive tightening of financial conditions, and the Feds can continue to put the pressure with the fight on inflation. This leads to that dollar domination narrative starting to come back into the scene, and we saw gold, EURUSD, GBPUSD, stock market, and dollar individually reject some very key price points of interest, with potential reversal starting to come into play now, and starting to look for the dollar domination bias, which we were playing so actively during the 2022 period. So when you're looking at your various key asset classes across the board, you can see buyers exiting positions from very key sell side liquidity zones on gold here into the 1960s, fundamentally induced by extremely optimistic labor market data, leading to the markets pricing in potential more aggressive tightening of financial conditions by the Federal Reserve. We also had some more hawkish Fed speakers that followed after, and even Jerome Powell today still putting the pressure on the hawkish sentiment and the fight on inflation. So it's not just gold as a precious metal and individual asset class that rejected a key price point. When you're coming to look at market sentiment individually, you can see dollar also having a bounce from a very, very key demand zone and historical price point at 102, where we also saw significant buy-side liquidity generated during the entire bull run and dollar domination phase of 2022. As we had that bit of a correction, we just had a 50% correction of the overall larger impulsive rally and move, pretty much just setting up order flow, creating economic and price stability, as dollar domination during 2022 had a lot of negative impacts on emerging countries and other country currency values, to the point that we saw a lot of countries doing currency interventions during that period, such as Japan and China. But now, as we're coming into this new year and having a pullback to that very key demand zone, we have the fundamental catalyst of still hawkish pressure from the Federal Reserve and very optimistic labor market data creating this bounce. So if we do not see dollar breaking back below 102, gold holding well below the 1950s on the higher time frame, we can easily start to see the dollar domination phase come back into play. If you need more information on this, make sure you watch the 2022 review and 2023 forecast expectations webinar, as well as the market update webinar from last week, where we are breaking down scenarios for the rate decisions and data to come, talking about these higher time frame price points of interest. Also, it's not just gold or dollar individually. When you're looking at some of these major currency pairs, all we had is a pullback into this new year to retest previous key zones that were broken, not fully correct the bearish impulsive move, and still having this double top on GU weekly induced by the data report retesting these previous higher time frame lows with easy potential to drive back down into the lows printed at 1.1 as long as dollar remains stronger, and especially if we have optimistic US economic data and a high CPI report next week. The main focus point to continue dollar domination and the sentiment of the Fed's further tightening financial conditions and focusing on the fight on inflation is going to be a high CPI report, which I was personally predicting can be the next one coming next week for the US there. As commodity prices were still very high, equity prices high, wages surging, and overall consumer side inflation at the checkout very high still, I can see that we're going to start to see CPI start to rise again, feeding into the dollar domination narrative and having the markets price in further tightening of financial conditions by the Fed, leading to stock market bears, gold bears, and dollar bulls. And obviously on GU and EURUSD bears, especially if we can't break back above this very key zone we broken. Very nice just pullback and 50% correction of the overall bearish move. Starting to get good technical confirms of buyers exiting out and sell orders coming in with that double top. Potential further optimistic US data and high CPI will have us trending back down into 1.15, 1.0. You can see a very similar type of price setup on EURUSD as well here. Even if the ECB is hawkish and going to put the pressure on rate hikes, it's not going to be able to overtake the strength of the dollar as the world reserve currency and global business currency. So you can see, really for the end of 2022 and start of 2023 right now, all we were having was order flow setups for this new business year, retesting very key liquidity zones and price points of interest here, and still not breaking overall bearish structure on EURUSD, bearish structure on GU, bullish structure on the dollar individually, and still having dollar domination potentially coming back into the scene. So you can see that during this exact same time period where the interest rate decisions and US economic data was in focus, EURUSD retested previous higher time frame lows and also still failed to break higher than there, just retesting there and potentially generating some more sell side liquidity and sellers jumping back into the market. Similar type of idea with GU revisiting that price point of interest, gold rejecting the 1960s, dollar holding the support level above 102, and equities here also rejecting a very key liquidity zone, which was previously used as a buyer demand area, now turning into a sell side area when you're looking at the previous bullish rally. And of course, when we shifted into the bear market here. So if equities can no longer break above 34,500, we see volatility index picking up more strength, other global equity markets starting to turn more bearish as well and giving back some gains, and dollar picking up some more strength, we can easily continue the bear market on equities, which would still be maintaining a soft landing on the stock market, not on the economy, and still be maintaining price stability, as even if we start trending back down bearish, we would just be revisiting price points the market and economies have already been well adjusted to back to pre-pandemic highs. So basically, in terms of quick market sentiment, we are potentially seeing dollar domination come back into the scene. Gold well below the 1920s, even give or take a pullback, is now bearish. Potentially reversal starting to come back into play now. GU turning back bearish to revisit the lows. Gold starting to flip bearish in structure, revisiting into the 1700s. EURUSD flipping bearish, no longer breaking above 1.1, starting to go back down to the parity point 1.0. Potential bear market continuing on equities as stock market buyers, if they fail to break above 34.5, can easily see the tightening of financial conditions by the Feds holding more weight. Now, in terms of economic data, the neutral FOMC last week held very short-lived impact as there wasn't really anything new brought to the table and we just had the expected well-known market-adjusted rate hikes. But what was the kicker last week that started to bring back dollar domination, aka dollar strength and outflow out of some of these other asset classes, was extremely optimistic labor data. The extremely optimistic labor data shows that inflation is still anchored to the increased risk side, alongside these commodity prices and other asset prices being high. And it also shows that the economy is still robust enough to handle tightening of financial conditions by the Federal Reserve. The market starts pricing that information ahead of time, of course, just based on simple anticipation, and always trying to be ahead of the curve and have a market edge. And we saw dollar turn extremely bullish, gold bearish, and stock market really failed to break above 34,500. We also had some more hawkish Fed speakers that followed, and even Jerome Powell today further cemented the fight on inflation. Now, we don't really have any key data reports in focus this week. The next major fundamental catalyst in focus, whether we have dollar domination take off or still continue the previous bias, is going to be CPI data next week. That's the main focus for investors, the markets, and to see whether we continue the Fed sentiment of tightening financial conditions and get those conditions further priced in. So next week, if we get what I predict, a high CPI report on top of robust labor market data and the Fed's continuing to put the pressure on the fight on inflation, then that's going to be the main kicker next week for dollar to explode in value and turn aggressively bullish, gold to start trending further bearish, stock market to start flipping bearish and having an outflow, and obviously having the dollar domination narrative come back into the scene. But for this week, we are starting out this week relatively slower in terms of volatility and lower in terms of volume, as a lot of the major fundamentals such as the central bank rate decisions, labor market data has been priced in. But this dollar strength, as well as outflow out of gold, is still holding weight, and we still have potential to continuation. We still have potential for continuations of that NFP sentiment, as long as when you're looking at market sentiment on the intraday time frames here, as long as we don't see dollar break back below 102.5, it's starting to flip very bullish and respecting a very key buyer demand zone on the higher time frame. As long as the stock market can't break above 34.5, we're going to potentially see an outflow and stock market sellers come into play. And as long as gold can't break back above the 1920s and correct this impulsive downside move, we're still very bearish here on gold. Now, market sentiment wise, we want to play the current dollar strength influenced by the extremely optimistic labor market data and, of course, the pressure from the Feds coming back on the fight for inflation. Japanese yen still macro bearish as the Bank of Japan is keeping their monetary policy loose, still keeping interest rates in the negative, and ready to do more bond buying or monetary easing if needed. And equities are starting to soften in various regions across the board. So when we're looking at market sentiment now, as long as dollar's holding above 102.5 or flipping back above 103.6 key level, it's still very potentially bullish, and we're playing a bullish dollar bias. As long as Japanese yen individually is holding below 78.6 previous higher time frame liquidity zone or flipping below 76, yen is still bearish. And as long as VIX is still holding above this 18 support, we might not see any more buyers jumping into the market on equities, as long as equity is still rejecting in terms of US 30 below 34,500. You can also see global equity starting to slow down here with, of course, German DAX still having this exhaustion. Australian stock market index seeing some buyers liquidate positions, and equities, of course, ranging as well here. So we are starting to see the demand in equity soften, dollar domination starting to come back into the scene as the markets are pricing in the more optimistic labor market data from Friday, leading to an increased probability of the Fed's further tightening financial conditions, potentially doing more rate hikes as Jerome Powell signaled today, holding rates through 2023, and then the markets are, of course, going to have to price that information in. So now, before we jump into the individual analysis on gold with the technicals and fundamentals, GU, GJ, and so forth, we just want to understand what events we do have on the table in the coming sessions in New York tomorrow. But this week is expected to be relatively quiet, as a lot of the major central bank rate decisions have been priced in. NFP data has been, of course, priced in and absorbed by the market as well. And we're just going to be looking for some of these continuation plays of last week's market movement. So we don't have too much going on through the Asian session here. And pretty quiet over London and New York as well. So not much going on tonight at all. Expect maybe low volume and volatility, maybe some consolidations and ranging across the board, as we don't have any real geopolitical tensions or reactive events to price in or continue to adjust to. And we don't really have any economic events in focus. So nothing really going on through the Asian session, nothing really going on through the European session, and nothing really going on through the North American session in the morning. But tomorrow, outside of any pre-planned economic data, we do have a bunch of central bank speakers. John Williams, we have Raphael Bostic, Lisa Cook, Neil Kashkari, and Christopher Waller. Majority of these Fed speakers are more on the hawkish side of further tightening financial conditions and putting the pressure on the fight of bringing inflation down. So this can potentially lead into from 9 a.m. Eastern into late afternoon of more dollar strength, stock market bears, and gold bears. But other than that, not much in focus of data. Now, when we're looking at gold here, as I've explained many times, when we saw gold and we played that bearish market structure from the 1900s to the 1600s, this was the narrative of dollar domination holding the most weight, and the markets, of course, pricing in the front loading of Federal Reserve rate hikes from early 2022 to November 2022, but also having economic events week after week and month over month that supported that sentiment, which was, of course, relatively robust labor market data, hawkish Fed speakers and hawkish FOMC statements, and high CPI reports. Then from November 2022 to about the previous week, we had the Fed pivot narrative holding the most weight, where the market was potentially hoping the Feds would pivot as we started to get catalysts that were going against the dollar domination phase. We were, of course, starting to get declining CPI reports, bad labor market data, bad PMI figures, and more neutral Feds as we were having order flow being set up into the end of the fiscal year, still keeping consumer morale and market optimism high into the end of the holidays, end of 2022, and setting up better price points of interest coming into this new business year of 2023 on the macro perspective. Now, as gold is rejecting very key sell-side liquidity zones at 1860. Last week, we had a catalyst that's potentially starting out the dollar domination phase again, which was very optimistic labor market reporting. Okay? So if we get any type of pullback phases here, even to retest like the 1900s and form more defined bearish market structure, or just start breaking these lows, and we have dollar strength, of course, and more optimistic economic data and high CPI reports, we're easily going to start to have the dollar domination phase come back into the scene, right? You can see a similar type of chain of events when you're looking at EURUSD on the higher time frame and GBPUSD. During this period through the primary phase through 2022, the markets were pricing in the front loading of rate hikes by the Federal Reserve. Even though the ECB was raising rates as well, it doesn't matter against the dollar, as the dollar is the world reserve currency and global business currency. As we are approaching the end of the year, we just had hopes of a Fed pivot as we had declining CPI reports from November, December, and January. But the fight on inflation is nowhere close to being complete yet, and as we're retesting previous key zones and only doing a 50% correction of this overall macro bearish rally, a bearish downside move there. If we cannot break back above this key zone and have high US CPI reports, strong US economic data, and hawkish Fed speakers, we're easily going to start to be creating some waves all the way back down to 1.0 to 1.0. And of course, similar idea there on GU. Obviously, the inverse when you're talking about market correlations and you're looking at dollar, as dollar, after this very extensive bullish rally through late 2021 and 2022, just had a correlated correction and setting up order flow for this new business year of 2023, and still just retesting very key previous demand zones seen from a historical perspective, and even through the bullish rally of 2022, as now we're having potential catalysts for dollar domination coming back into the scene. If we have high CPI reports, hawkish Fed speakers, and we can't break back above 102, we're going to be starting to trend bullish back into these 20 to 25-year highs at 108, 110s, and 111s. So just keep that in mind as you're starting to observe data reports that get released for the US CPI reports and Fed speakers in your headlines, right? What we need to see for the gold reversal and continued bears, dollar bulls, stock market bears, EURUSD bears, and GBPUSD bears, what we need to see is the next CPI reports in the US being higher than previous and higher than expected, the US economic data still being relatively robust within Fed expectations, and hawkish Fed speakers during their interviews and speeches. Okay? But anyways, that's just a quick little fundamental review, macro review, and let's jump into the trade ideas and analysis to come. So on gold here, you can see we had a quite impulsive bearish moves from optimistic US data and indecision with the rate decisions from ECB, Feds, and Bank of England all in the previous week, as well as we were just setting up order flow in the new business month of February. Then we had an accumulation of order flow here and another impulsive leg down, which was extremely, extremely optimistic labor market data. NFP being at like 500K, unemployment rate dropping by like 2 points there, and wages data surging and being relatively healthy as well. As a lot of that information has been priced in, we've just been in a secondary phase of market structure, which is a consolidation. Today, during the late New York session, we had some liquidity grabs on the dollar as well as gold, as we had Jerome Powell doing an interview where he did give some remarks on monetary policy. Now you can see we're still rejecting these range highs where it's difficult to see any type of pullback plays unless you're breaking above 1880. Otherwise, when you're looking at overall structure here, what's very interesting is we are ranging in the last place we had an accumulation of order flow, which this was in bullish structure. And we had a declining CPI report here that led to Fed pivot prayers continuing further. Now we're having bearish structure form, fundamental catalyst for downside, and we're generating order flow and accumulating order flow in the exact same price point of interest, where I'm expecting liquidity grabs and instead having legs down to like the 1830s, right? Now, obviously right now we're just consolidating. It would be ideal to get the break below or rejections of 76, but we don't really have any reason to be buying gold unless we can see a potential pullback, which maybe if we break above 1880s, I would see short-term buys to retest very key liquidity zone in the 1900s before further sells. Otherwise, I'm pretty much looking for trades like that. So bringing that information together in terms of some key levels in intraday analysis, these are the trade ideas I see on gold for everybody. Now, if we just get daily candle pullbacks and holds of 76, sells. Breaks below 1864, sells. Breaks below 1855, sells. Confirmations of this as well in terms of intermarket correlations. would also be dollar individually holding more bullish or continuing more bullish. The only way I see gold buys with the current fundamentals in play, current market structure and price action, is a short-term pullback. If we break above 1880, I could take advantage of some pullback buys, but would really just be retesting the 1900s and that higher time frame zone to still take better sells. Okay? Now, this is going to be similar types of trade ideas on any other of these asset classes or currency pairs where the information advantage that's been driving order flow has been Fed sentiment. Whether you're having the Fed pivot prayers and that narrative holding the most weight, or whether you're having dollar domination come back into the scene with a more hawkish Fed approach and, of course, very optimistic data. So on GBPUSD here, you can see on the higher time frame, last week we rejected a very, very key major zone after having a pullback phase just to start out this new business year. Nice double top, just showing us buyers exhausting out of the market and sellers jumping in hand. Very nice bearish engulfing candle that was induced by optimistic labor market data, canceling out almost 3 weeks of bullish price action. As long as we cannot break back above like 1.21 handle here, we still have dollar strength. We can potentially see the higher time frame bias coming back into play and starting to make our way trending back into these low points on the higher time frame. What we're going to need to see for that day after day and week after week in terms of fundamental events is increasing US CPI, other US data being optimistic and still relatively robust, and hawkish Fed speakers. When we're coming to our intraday time frames here, you can see we're starting to form some stronger bearish price action and potentially coming out of that bullish pullback phase. I can still see us driving down into 1.19s or having a bit of a pullback to 1.2 and still coming down to these very key range lows on the intraday perspective. Order flow just talks about the actual institutional orders entering the market. That's printing bullish structure, bearish structure, consolidations, or these different phases that we observe when we're watching the charts. Order flow is always entering and exiting the market. It's not just an accumulation of liquidity. An accumulation of liquidity is one phase of order flow when you may have less volume and volatility, or potentially waiting for key fundamental catalysts as information driving factors. But anyways, on GBPUSD, if we break above 1.21, I would still be looking for better intraday and higher time frame sells from the key levels, and you could take advantage of that short-term pullback play. But remember, it'd just be a pullback to lead into retesting these better sell zones. Now you can see the same indecision that occurred today with Jerome Powell there, obviously during the late North American session. But we still have a hawkish Federal Reserve and expecting more rate hikes and holding rates up. We still have very optimistic NFP data holding weight. We're still getting rejections to very key higher time frame liquidity zones. And we still have dollar strength starting to pick up here. So on GBPUSD, EURUSD, gold in the stock market, give or take some pullbacks, I still want to be primarily looking for sells unless we have a fundamental catalyst otherwise. In terms of reactive fundamental events, like planned economic reports, we don't have anything to shake out of dollar strength at the moment. And we don't have any geopolitical tensions coming to the table as well yet. We don't really have any China-Taiwan escalations. We don't really have any further escalations with Russia, Ukraine. We don't really have any other geopolitical tensions like trade wars coming back to the scene or really anything of that nature. That's new information for the markets to price in. EURUSD, similar idea here. Even if EU retests 1.087, just holds below 1.073, breaks below 1.065 higher time frame key levels, I am going to start to look for potential more sells. Playing the dollar strength, central bank sentiments being priced in, dollar going to hold more weight in this currency pair as the world reserve currency, and of course as your global business currency. Starting to have some stronger intraday bearish price action and structure forming. Potentially starting to break out of this pullback phase on the higher time frame, especially if we continue to hold below that liquidity zone and potentially be revisiting and driving down into 1.05. Now, USDCAD is more of the inverse, as the dollar is the primary in this trading pair, and we're still holding macro bullish market structure with very nice demand being respected at 1.32. If we can start to flip bullish above 1.34 handle roughly, we can start to see UCAD trending back into these higher time frame highs. Now on USD CAD, we're more in an intraday range, but as the Canadian dollar's weakening with oil turning a bit softer with these other major asset classes, on the markets pricing in further tightening of financial conditions by the Fed and that very optimistic labor market data, as dollars holding a bit more strength, if we break above 1.34, 1.35, and 1.355, I would be looking for USD CAD buys. I can only see UCAD sells at this point, with the dollar completely fading out the NFP move and USD CAD breaking below 1.331. Now, US equity markets are in a very interesting price point and make or break area, where if we don't break above 34,500, which you can see previously was used as a very key buyer liquidity zone, then as dollar domination came into the scene, it switched into a very key price point of interest on the sell side. If we do not break above 34,500, dollar continues to hold strength, VIX picks up some weight as well, global equities turn a bit more bearish, we might see one more little sweep of these highs, but then start turning bearish to these range lows and potentially even continuing lower next week with a high CPI report and continued hawkish Fed speakers. Overall, though, on the intradays, we're in a range that I personally do not want to touch. From 33.5 to 34K, this would be a no trade zone for me. And it makes it very easy for us to analyze and mark out trades as well. Very simply, we understand that we can't see any further buys unless we're breaking well above the range at 34.5. Otherwise, if we start to trade below 33.8, 33.5, and 33.4, with the dollar strength still holding more weight, volatility index turning bearish, global equity region starting to give back some gains, and the markets pricing in the further tightening of financial conditions by major central banks, in this case being the Federal Reserve with the focus of US equities, we can easily start to see sellers jump back into the market, flipping bearish to the range lows. Last but not least is GJ. Now, yen is still bearish on the higher time frames. We've just been having a pullback phase in relation to higher time frame bearish structure to start out and set up order flow for this new business year. You can see we're still rejecting a key sell side liquidity zone. Nice double top there from a dovish Bank of Japan sentiment, and we still are holding below these price sensitivity areas, where if we don't break above 77.5 or break below 76, higher time frame yen bears can easily jump back into the market with more sellers in control, and we can still extend GJ buys on the higher time frame. But overall, with the Bank of Japan rate decision in the previous weeks, Bank of England being more neutral and mixed, plus some mixed economic data over the last couple of weeks, GJ has just been in this very messy range pretty much through the start of 2023. Now, if we can't break below 157, I still see high risk buys, and I also see continuation buys above 160s. I can only see further GJ sells to revisit monthly lows and previous higher time frame lows if we break below 155 with more yen strength, which we do not have at the moment. The weekly gap on GJ has also been filled as well. I would be looking for high risk, high reward buys at 157.5, breaks above 158.2, breaks above 158.5 buys on GJ still. I can only see sells well below 156.8. GJ is still very bullish in macro structure on the higher time frame and having very similar pattern repetition compared to this post-2008 global financial crisis rally. We still have the macro rate differential of a more dovish Bank of Japan and hawkish Bank of England. We're still just setting up order flow for the new business year. If we cannot break below this very key demand zone in previous highs, it's hard to see any sells down to this next price point of interest into the 150s. We could easily just generate more order flow here before continuing bullish, which is very common in GJ movement and behavior. But anyways, everybody, a very value-filled and educational-filled session. We went through some key fundamental review, what fundamentals are holding the most weight, market impact. We've seen, of course, some macro analysis and macro review, some technical analysis, what events we have in focus, and some trade ideas across the board. You can always rewatch this as you wish. It's going to be saved and uploaded. If you enjoy this content and want me to do it more often, make sure you send a like, subscribe, and comment. It's free to do. Make sure you watch last week's market update for even more valuable information to supplement and complement with today's. Make sure you watch the last higher time frame webinar, 2022 recap and 2023 refresher, and the free educational webinar on adapting to volatile market conditions. I'm going to be making more appearances on Raja's morning streams, and in the next coming weeks, I'm going to be doing New York scalping sessions on YouTube once a week as well. Maybe in the next few weeks once my schedule's cleared up. All right. Make sure you check out the Capital Hungry Free Twitter for news headlines, trade ideas, charts, banter, and analysis. The Capital Hungry Free Telegram for my trades. My trades are also posted on Twitter and stuff like that too. For informational posts, motivational, psychology reminders, and so forth. Make sure you check out the Capital Hungry Instagram with tons of free informational short form content, reels, data reports, newsletters, and a lot more. Nobody compares to Capital Hungry, value given for free and for paid. You can't find anything else like this out there in the retail trading community. Everybody else is focusing on Fibonacci's, EMAs, just support and resistance, and repeating the same cookie cutter stuff. But I'm here trying to help you increase your knowledge on economics, what's going on in the real world that's impacting these asset classes you trade and risk money into in a market where 90% lose. So just trying to help everybody out. Yeah, I don't mind any of the trolls or anybody doing stupid comments. I don't mind, because at the end of the day, you have to understand those individuals are very low IQ. They're not having any trading success that they could prove. And they also are still just giving me interaction. So it still keeps the chat rate up. They still watch the whole stream. They still keep commenting. And at the end of the day, it's just numbers for me. So if you want to keep investing your time into me as a troll or hater, hey, I don't mind. Bring some of your hater friends as well next time. Bring a whole group with you. I do not mind.